In this module, we will just take a quick look at the common stock market myths that you might have heard from your network of friends and family. The first common myth is that the most important thing in investments is returns. Well, guess what? The most important thing in investments is not return, but it's portfolio risk. Managing your portfolio risk will take you far and long in stock markets. As an investor, you can make more money by knowing and controlling your risk. Risk can wipe out your entire capital, which is finite, small or large. Knowing your risk is important to keep your capital intact. Hence, never forget to put stop losses, close the position and move on with the next trading idea. When I say stop losses, you could face either of the two scenarios. The first scenario could be that when you buy a stock at a lower price and you expect it to move up, always know and have a target in mind of the price at which you will sell it when the stock moves up, and then sell it at that price. Unless you have important information that will tell you for sure that the price is going to move further up from where it is. When your target achieves, be sure otherwise to always sell the stock and not keep waiting that the price may move further up. Even after selling, you will commonly hear from your friends and family that the stock has moved further up and you could have waited, and you might end up doing this in the next stock investment that you make. Don't. Always, always, always have a target price of selling whenever you pick a stock and you buy it, and sell it. Ensure that you place the sell order at the target price that you have thought of. The second scenario could be when the stock goes below the price that you bought, so it starts making losses for you. In that case also, do not panic. Have a target stop loss, a stop loss price below which if the stock falls, you have to sell it and book the losses in your portfolio. Again, unless you have important critical information that tells you that the stock is going to move further up in the long term, book the losses. A common idea of stop loss targeting is at 10%. So usually if a stock price falls below 10% of the price at which you have bought the stock, you should book your losses to protect your capital. Remember, never ever forget to put stop losses, close the position and move on with the next trading idea. The second most important myth commonly heard is that success in the markets is all about studying the market. Let me tell you, nobody has ever made money by consistently timing the market. Nobody can ever know all that is there to know about the stock markets. A very popular quote is, "Do not time the market, spend time in the markets." As Warren Buffett says, behind every stock there is a company with a business. Try to understand how the business is doing. Try to get into the business model of the company. We'll get to understanding business models in the later few chapters. But meanwhile, you can follow the top performers on Track Invest and start learning and picking up trade ideas from them. So you should focus more on understanding the business models you're investing in. Don't worry about timing the market consistently. You can never be right all the time. The third key myth is to focus on the tried and tested large cap names. The investing game is all about generating alpha, excess returns, and finding such an opportunity in large cap stocks like Reliance, Infosys, etc. can be extremely difficult. Take calculated risks. We learned earlier that you need to know your portfolio risk, but you also need to take a calculated risk to make returns in stock markets. Find out companies that will emerge as large cap in the due future. Look at some examples. In the last 5 years, mid-cap stocks like Motherson Sumi, Eicher Motors and Lupin have multiplied 4 to 5 times. In the stock markets, the biggest risk is not taking any risk. So as a smart investor, you need to be on the lookout for such opportunities in the market. The fourth key myth is that you need complex strategies to profit in the market. That's not true at all. This is a big myth, as complex strategies are means to make a small return on a large capital outlay by identifying inefficiencies in the market. Inefficiencies are called as arbitrage. For instance, there is always a price difference between the NSE and the BSE stocks by a marginal amount. But if you invest a lot of money in one stock, you can take advantage of these price differences between the two exchanges by buying in one exchange and selling in the other. However, this is not required for a retail investor. Just keep it simple, look at identifying key companies with good business models and look at a long-term strategy. Take a look at Eicher Motors, for instance, 5 years back. A growing market, hardly crowded, low capital requirement and high return on equity was a classic combination to create wealth. Look at Britannia in the last 3 years. A focus on the premium biscuit segment with low competition and high margins almost turned the tables for the company that is 10 times in 3 years. So keep it simple and avoid the standard pitfalls. Just pick good stocks with a long-term vision. The fifth common myth is investing in stocks is gambling. This is the most common myth that you would have heard, especially from your family and folks in India. Holding a stock is equivalent to having a percentage ownership of running a company. That is an asset that creates value. Investors are always assessing various companies and their future profits that determines the price movement of the stock. Assessing the value of a company isn't an easy practice, and the short-term price movements appear to be random. Sometimes academics call it the random walk theory. Gambling, on the contrary, is a zero-sum game, as it takes money from a loser and gives it to a winner. No real value is ever created in gambling. So remember, investing in stocks, if done correctly and in a disciplined manner, can help you build and grow your personal wealth. I'd like to end this through a quote by Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. Just be patient, be disciplined, and continue picking the right stocks to build a winning portfolio. In terms of next steps, you can go through the quiz questions and the exercises at the end of this chapter. Start building your portfolio on TrackInvest. For this, refer to the video for the platform demo on TrackInvest on our blog. Join the competition BTC by Internshala for that particular month and start practicing. Remember, the quicker you finish all your modules, the more time you have to build your portfolio and practice on trackinvest.com. Best of luck.